Hi, Paul. We've known each other for a few years as industry colleagues, LPs. So I'm really pleased. Thank you so much for taking the time to meet with me today in Miami. Could you please first introduce yourself and maybe share with us the key milestones of your successful professional career?
Thank you, Louis. I'm so happy to have this conversation with you. We've been friends for a while now, and I'm really happy to be part of this. So my background is, after graduating from business school, I came into the commercial banking world with Citi. I spent the better part of 2 decades in commercial and investment banking, first with Citi, then with Dillon Reed, and then a boutique investment bank in financial services. And at that point, I went over to the private equity world where I spent the last 23 years. Some of the things that I'm most proud about in my career have been related to 2 of my strengths, I would say. I'm very good at problem solving and growing businesses. And so an example of that would be when I was at Citibank, I worked for the government of Mexico that was raising money for their oil business, Pemex. And this was back in the 1980s when Mexico was a non-investment grade company, and they were looking for the most efficient ways to raise debt. And my group went out and created the first investment grade transaction for a Mexican issuer by securitizing the sales of their oil to large and investment grade U.S. customers like Exxon and Mobil. So that was a groundbreaking transaction. That was something that we did in problem solving, figuring out the solution. And then at John Hancock and Manulife, which I joined in 2001, when I joined, we were a single asset business that was based solely in the United States and managed $500 million in assets. And over the last 2 decades, I've helped to grow that business into a multi-asset global company with over $25 billion of assets under management.
And could you please present the private equity program that you are running at Manulife?
Okay, so as I mentioned, our team managed $25 billion in assets, and that incorporated making limited partnership investments into funds, which was roughly half of that amount. And then we also had a business which was investing in direct deals, in equity co-investments, mezzanine debt, direct lending, and secondaries. And what we did was we used those relationships with those managers to help fund and feed those transactions on a direct basis, where we manage money not only for the insurance company, but for other investors as well.
And what is the exposure of Manulife to private equity as a percentage of its assets under management?
So Manulife has as an insurance company, has a large balance sheet. And the target that we have is 10% of our assets under management. It's not a hard cap. It will sometimes go higher or lower, and the company is comfortable with a little variety and volatility in that number, which is very helpful for us in managing the business.
And what makes private equity so attractive for a large insurance company like Manulife?
So I guess first and foremost, it's a very attractive asset class because of the returns over a long period of time have been very significant. The other, so when you look for equity exposure, your choice is to do it in either a private investment or in public markets. Public markets have the problem for insurance companies, particularly public insurance companies, of the volatility, which would impact our earnings. So we think that private equity is a better way to go for investors, and we like the fact that you get paid for that illiquidity. So you get, we think, a better return on a long-term basis than the public equity markets.
So let's talk about building a successful long-term private equity program. Do you think it's important to have a strategy with a specific, target geographical exposure, target sector exposure, or maybe target diversification by market segment, lower middle market, mid-market, large cap? Maybe you have a target number of managers and or even target exposure by fund size ranges.
Right. I think it's very important before investing in anything. You really have a goal, and you think about your risk and your reward. I don't think it's one size fits all. But what I would say is that we liked investing across different sectors, different market caps and geographies that had the extra benefit of diversification, which resulted in having more stable earnings over a long period of time.
And what would be your target strategy if you were setting up a private equity program for private individuals?
So again, I would talk to that individual who we'd be investing with or on behalf of and know what their risk reward tolerance is. Because it is not a one size fits all as well for the individual. But what I believe is that private equity, and particularly buyouts, provide very strong risk reward return for the investor over a longer period of time. So if I was to devise a plan for an investor, I would say invest every year. Don't try to be trying to figure out what the right time is in any particular vintage, but set aside an amount of money in your portfolio that is a liquid that you don't need to to use for your everyday needs. Invest a similar amount every year, and then invest in a broad range of managers that would be the best managers in the market.
And how important do you think it is to select the best funds, and how difficult is it to access those top quality funds?
Great questions. If you think about it, a couple 100 basis points over a long period of time turns out to be a whole lot of money. So you definitely want to not just pick the market and try to outperform it. We've been very successful in doing that within our team. We've had the advantage of having great access to the market. And I think the access to the market has to do with a couple of things. One is if you've been in the market for a long period of time and develop a reputation as a smart, stable partner to the private equity firms, they're going to want your capital. And so that's really been what's driven our ability to get access to the best managers. And as you know, Europe has been a newer market for us, and we've been able to access some of what I think are the best managers in Europe, in part because of that reputation that we built over many years.
And I think you touched on it, but how important is it to invest regularly across vintages?
I think that GPs are understanding if you have to go up or down a little bit from fund to fund, but what they don't like is those limited partners that are come in a large way in one fund and then they're not in the next fund. So what we found is that if we have to taper our commitments to a GP by 25%, and we're very transparent and explain to them what those reasons are. Maybe we're overexposed to them as a manager. Maybe it's due to the demand needs of the insurance company. They understand that. And so, but at the same time, if we want to stick with these managers for long term, we want to be in every fund.
Yeah, and when I started as an LP at MetLife and started to build a portfolio in European buyouts, so I invested really regularly across vintages, built my portfolio, but then 2/3 of my managers came back to fundraise over an 18-month period of like 2021, 2022. Right. And so, to your point, I didn't want to lose those relationships, so I had to re-up with them. And that meant that I had to ask for more capital for those vintages. And so, as a result, we were mechanically overexposed to those two vintages, and vintages of hot fundraising markets are usually not the best ones, right? Yeah. So mechanically, you tend to be overexposed to the bad ones. What's your perspective on that? How do you think it could be managed?
So there's a few things that you can do to manage that. When you have like 2021, where everybody was coming back, asking for capital, and we weren't seeing a lot of capital coming back to us. So there was a problem of overexposure in the marketplace. There is a secondary market to sell your LP interests, and a number of investors, as you know, have done that to sort of give themselves the capacity to commit to other funds. At the same time, you don't want to sort of, as that manager is growing their funds, not necessarily grow your commitment at those points in time as well.
Makes sense. And at Altaroc, what we chose to do is to have an annual fund of fund. so that you do 5 to 7 funds per year, but that's it. You have to follow that discipline. Yeah. So even if we had been active in 2021, 2022, we would have had to do 5 to 7 funds every year. That's another way of doing it, but to maintain that discipline of trying to have the same exposure to each vintage. If we talk about manager selection now, what makes a private equity manager better than another, according to you?
So obviously, returns are where we start as far as the manager, and we look for managers that are first or second quartile in most of their funds. If they slip to a third quartile for one fund, that's not the end of the world, but we look for funds that outperform over a long period of time. But the other factors that we look for in a manager are stable teams, low loss history, and I have to say the managers that I like the best are the ones that are really transparent, the ones that communicate well. They tell us when things aren't going well. They tell us early. And those are the ones which we gain confidence with and conviction with, that they can be good partners with us.
And some people think that selecting funds is easy. All you have to do is pick those managers who have done really well in the past and just look at past track record, take the best track records, and that will work out. What's your perspective on that?
So in my opinion, that would not be a good long-term successful strategy. Long past performance doesn't guarantee future results. And I think the reason that I say that, it's not a good strategy of just looking at the performance is that you have to think about the private equity firm as almost a living organism. People come and go. People age. The strategies may drift. You have to really have somebody like myself, who've been in this business for a long time, know these people, and can see and, they know these teams and they see them all the time, and they can identify where maybe something is changing and where maybe their strategy doesn't work in this marketplace. So I don't think that's a great recipe for success if you just look at past performance. I think you really need somebody who's in the marketplace who really knows the managers well.
And I always say that committing to a private equity fund is like signing a blank check for 10 years. You really, to your point, you really need to know those people. And probably the most difficult part of our job is actually the qualitative assessments of those managers. How did you benchmark those managers? You were large cap versus large cap, mid-market versus mid-market. Is there something around the segments of the managers?
I would say yes. We do benchmark them. I wouldn't say that we necessarily benchmark it by cap that much, but where we did get into the area of measuring and benchmarking the managers were if you had a sector fund, so like a Thoma Bravo, who's big in software and technology, we wanted to compare them against their competitors. How did they perform? How did they compare against public markets? And we did that with healthcare and financial services, things like that. But so that's how we would benchmark it. And overall, if you can generate 15 to 20% returns, 2 times your money over a long period of time, you're doing well.
You touched on it already, but what are your key manager selection criteria? So
track record, team stability, low loss history. Part of our business strategy was co-investing. So we like managers that would provide co-investment opportunities. Those would be some of the key characteristics that we would look for.
Finally, turning to the market environment, what's your perspective on the current market environment? Do you think it's a good time to invest?
Well, we talked about this already, which is you don't want to necessarily time the market. It's a 10-year investment, and you want to be in for the long haul. So I would say, don't think about it that way. Having said that, there are times where, in a point in time that you may feel better or worse about private equity. The last couple of years haven't been the best performing years. They've been more challenging. There's been a lot less deal flow. What I see going forward, though, is that we're going to be entering into a market in the next couple of years with lower interest rates, which will, I think, drive more deal flow and more activity, and hopefully, more strong returns in the future.
And how do you see the private equity industry evolve over the medium to long term?
it will continue to evolve. It's a segment that has long-term growth. It's had a tremendous amount of growth in the last 2 decades that you've been involved in. I've been involved in the business. I don't necessarily think it'll grow as rapidly. There's 2 fundamental or 2 particular things I think about that are going to be trends in the marketplace. One is on the fundraising, capital raising side, where the individual investor is going to make up a more important part of the capital base for the private equity industry. I think that is something I feel really confident about. The second thing is that technology and artificial intelligence are going to have an impact on this industry, and not only the companies that we invest in, but for the private equity firms, the use of technology and artificial intelligence to help them make investment decisions, manage investments, are going to increase, and that's going to have a profound effect on the industry and, in fact, the private equity firms themselves.
Very clear. Thank you very much, Paul, for taking the time to speak with me today. Talk about how you approach investing in private equity and sharing your insights on the market. Thank you again. Okay. Thank you.